All right, thanks for coming, everyone. As Tim said, I'm talking about the one of the favourite topics on the blog, something we write about all the time. The Great Australian Housing Crash ? Which doesn't mean a crash is coming, but we'll investigate that topic. So first of all, look, just to give a really quick overview, I'm not going to go bang on about this for too long because we all know the story. Australia's house prices have absolutely skyrocketed over the past 20 years. As we all know, it's almost represents a hockey stick where we've had almost near exponential growth. And we've had a 145% real increase in house prices over 20 years. And it's obviously come off a little bit recently, but the chart speaks volumes. This goes back over 100 years, and it really shows a ramp up over the past 20 years. Now, before 1988, Australian housing values were about 3 times incomes. So those of you who are a bit older, you probably got your house nice and cheap. My parents did. But for us younger people, it hasn't been such good times. Dwelling values are around 8 times incomes currently. And it's a bit of a strange, sad situation for the younger generations. As we all know, the most unaffordable in Sydney and Melbourne. This is a chart that comes from CoreLogic, and it shows the growth in the dwelling price to income ratio over the past, the past 20 years, or the past 10 years rather, or 15 years. And as you can see, Sydney's dwelling values, this is as at the end of 2017, so it would have changed slightly, was around 9 times income. Melbourne's around 7.5 times income, and they both increased quite astronomically. And they're way above the other capital cities. We're also very expensive compared to most other English-speaking nations. The only other nation that's more expensive than us is New Zealand. Now this data, I didn't have time to update it for all the nations because it takes, the data sources are a nightmare. But the relativities wouldn't have changed that much. Australia's come down a bit. New Zealand probably would have moderated a little bit as well relative to household income. And what's been driving this? We all know the key driver for house price inflation is obviously household debt. And on this measure, Australia ranks the second highest in the world after Switzerland. Household debt to GDP ratio, which is about 121% of GDP, is well above the other English-speaking nations. And it also has surpassed Ireland, which hit a peak of 117% of GDP just prior to the GFC, or the housing bust. So currently, as we know, dwelling values are correcting. Australian dwelling values have fallen for 11th straight months, and the way this month's going, it's probably going to be 12. They're down so far 3.3% as of the end of August. And so far this month, they've fallen by about another 0.2%, which you can add on top of that. So far, it's around about a middle of the road housing correction. This chart here compares this housing correction shown in red, in black, compared to the other previous corrections. The deepest of which was the 1989 to 91 correction, which went for 21 months and declined by about. Sorry, it's not the deepest, but the longest one was the 1989-91 correction, which went for 21 months. The deepest was the post-GFC correction, where values fell nearly 9% in rather quick time. And the downturn so far, or this cycle, has been driven by Sydney, where dwelling values have fallen for 13 consecutive months. They're down 5.6%. They've continued falling this month, so next month will show an even steeper downturn. Melbourne, as of the end of August, was down 3.5% over 9 months, and Perth's have fallen for 50 months, nearly 13%. So Perth's in a hell of a downturn. Now, I just want to zoom in on Melbourne, because you're all obviously from Melbourne, so that's what your primary interest probably is. So far, this dwelling correction is moderate, obviously. So far, it's only been going for, since the beginning of the year. It's, as I said, fallen about 3.5%, and for this duration of the correction, it's around about middle of the pack. So nothing to worry about just yet. Oh, yeah. Now, CoreLogic's got a great series that breaks down the price falls by segment. So it does the top 25%, the middle 50%, and the bottom 25%. And as you can see, the top 25%'s fallen the hardest. That's so far down 5.5%. The middle 50% is only down 2.5%, whereas the bottom 25%'s barely fallen. It's only fallen just under 1%. And the bottom end's been supported, in the same case in Sydney, has been supported by first home buyer bribes, whereby 1st of July last year, both the New South Wales and Victorian government basically eliminated stamp duty for first home buyers. And that's helped prop up the bottom end of the market. But Melbourne's valuations compared to all the other capitals has now hit extreme levels. So this chart here, I've basically gone through and compared Melbourne's median house price against the weighted average of the rest of the nation. And Melbourne's relative house prices are nearly 1.1 times the rest of the nation, the weighted median of the rest of the nation. That's compared to an average of about 90%. And during the downswings, it tends to get to about 75 to 80%. So Melbourne's dwelling values are extremely overvalued when compared to the rest of the nation. And the fundamentals are worsening. This is the same case in Sydney. Sales volumes are down 25% from peak. And as you can see here, there's a very strong correlation between sales volumes and prices. Just by comparison, Sydney's chart looks almost identical, except Sydney's down 36% since peak. So they're actually falling a bit harder. This is the big one. Housing finance is weakening. And this chart goes back all the way back to the early 90s, and it shows incredibly strong correlation between housing finance and price growth. So that doesn't augur well. Sydney's is even stronger than this. Sydney's has been falling harder, both in prices and finance. Auction clearance rates are obviously down. We all read the paper every week, probably no doubt read the Weekly Post. Melbourne's auction clearance rates are tracking in the mid-50s, and that's similar to the 2010 to 2012 downturn. And we've got a big reduction in foreign buyers in both Sydney and Melbourne, as well as elsewhere. Back during the boom period, foreign buyers of established dwellings was running at about 15% in Victoria, i.e. Melbourne. And now it's down to just over, nearly 9%. So it's fallen quite heavily. It's also fallen across New South Wales, as you can see. But there is one big difference. Sydney has the opposite situation. The supply is tightening in Melbourne. So Melbourne's added, as we know, I write about it all the time, has added nearly 600,000 people in just 5 years. So we've got manic population growth here. And the rental vacancy rate in Melbourne has actually halved. So it was running at about 3%, and it's now down to 1.5%. And this is, as you can see, Sydney's gone the other way. Sydney's rental vacancy rate's now rising, and it's actually, Sydney's has hit the highest level in SQM Research's series history, which goes back to 2005. And as a result, Melbourne's rents are actually running faster than the other major capitals, although they are weakening, whereas Sydney's are actually negative. So Sydney's, if you're a landlord in Sydney, you're in a bit of a pincer at the moment. You're facing falling prices, but prices are down about nearly 6%, as well as falling rents, which have fallen by 1% over the last year. And the only other market I've seen where this has happened is, in recent times, the last 10 years or so, is Perth, where Perth's rents are down 25% from peak and prices are down nearly 14%. So it's a pretty bad situation if you're a Sydney landlord, not quite so bad in Melbourne. Now the stiff headwinds facing the Australian property in general, but in particular Sydney and Melbourne, because they've got such a strong concentration of investors. In Sydney, investors still make up over half of mortgage demand, so it's about 52% of mortgage demand in Sydney is from investors. It's about 42% in Melbourne. But both of those are way above the other capitals. So first of all, as we've all seen in the past few weeks, we've got bank funding costs rising. The Australian banks have borrowed about $850 billion from offshore. And what this means is that as global interest rates rise, the bank's cost of funding rises, which is going to be passed on in one way, shape or form to home buyers. And we saw in the past week or so that Westpac, ANZ and CBA all increased their mortgage rates by about 15 basis points, or 0.15%. Obviously, we've got tightening credit standards in response to the Royal Commission. This has been going on for a while. It's expected to continue. we're facing a huge interest-only mortgage reset. So basically, due to regulatory constraints, there's a huge wad of interest-only mortgages that will convert over the next 3 years to principal and interest. And what this means is that repayments will, on average, increase by about 35% for these mortgages. But according to UBS, we're looking at $105 billion of these mortgages in financial year 18, $133 billion the next year, and they'll peak at $159 billion in financial year 20. This obviously means there'll be less interest-only mortgages coming online to push up prices, but there could also be potentially some forced sales and also some reduced consumption. And the big one, it's not certain yet, but Labor has committed over and over again to doing this, is of course Labor's negative gearing and capital gains tax reform should they win the next election, which looks like a shoo-in. If they stay with this policy, which by every indication they will, they're going to have support in the Senate. The Greens support this policy, which means they'll have no problems passing it through the upper house. This will likely come in probably at the end of next year. And this will have a particularly big impact in Sydney and Melbourne, again because Sydney's investors account for over half of all mortgages and over 40% in Melbourne. Possible saves, well, we saw Scott Morrison give his Menzies-like forgotten people speech last week about housing affordability, which is suddenly back on the agenda. And to us, that read in between the lines that he's probably going to throw some more first home buyer type bribes out to try and save the housing market. So what could we see? Potentially a rerun of the post-GFC first homeowners grant, as well as, I don't know, allowing first home buyers to access super for homes. On that point, I'll finish up and I'll hand over to Dave.